Welcome back to Open Interest. A check on the stock market right now. We're about almost 13 minutes into the session. The S&P 500 trying to hold on to its early gains, but then you take a look at big tech in the NASDAQ 100 slipping into the red. We know that Microsoft, Amazon, Meta, etc. are lower today. That is certainly bringing some enthusiasm out of this market, but not when it comes to the small caps. The Russell 2000 higher by about 0.6% right now, maybe helped by that economic data that we got at 8:30 this morning showing cool PPI, unchanged PPI, certainly a welcome relief for some of those smaller companies. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Palantir getting upgraded over at Mizuho on strong AI adoption. The firm says that Palantir's robust growth story appears intact. And remember, this stock has nearly doubled this year. Next up, we have Valero Energy and Phillips 66 getting cut over at Citi as analysts expect that downside risk for the oil and gas refiners to remain in the second half of the year. Shares down just a little bit. And we end with the chip and software design company ARM Holdings getting upgraded to a buy over at BNP Paribas Exane. The analyst says that there is significant upside to this stock, and you can see shares right now higher by more than 3%, 2% rather, Shanali.
And NVIDIA CEO Jensen Huang is now saying that approvals from the U.S. to send its H20 semis to China is expected soon. Katie, you've been keeping such a close eye on this story. Huang commented to reporters on his attempts to mitigate losses after President Trump blocked sales of the chip model.
Some of the things that we wrote off might be harder to recover, but most of the things that we put on reserve will not be scrapped permanently, was not scrapped permanently. And so we'll compare what customers would like to buy now versus the inventory that we have, and then we can figure that out. It's probably not 100%, but it's not 0% either. Tariffs. You know, the world is reconfiguring itself, and we are a company, and we just have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into NVIDIA. There will be trade, tariffs, and taxes after I leave NVIDIA. And so this is just this is something we all have to adapt to. But the very incredible thing is, NVIDIA is a very adaptable company. Our supply chain will have to adapt, and we will find a new way. Okay, so in the long term, it always comes back to this. Do you make products and technologies that are important to the world? Are you building things with great craft and care that customer deliver and receive benefits? And are you doing something that really impacts the world? And if those things are true, everything else will solve itself.
And joining us now, Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. One major question that remains for me is how much certainty is there to the return of billions in dollars in revenue that would otherwise have been written off?
Well, so it's unlikely that they will see any, recoup of the $8 billion in write-downs they had for the guide, but it is very plausible that second half may get a lift from additional China sales. And 2026, that's the big kind of focus for everyone, because you don't want growth to go from 60% to 15, 20%. It'll be much better if the growth is 25 to 30%, and that additional lift can come from China in this case.
So this isn't something we're going to see necessarily in NVIDIA's next earnings report, but something to look forward to. And we know that the stock market is a forward-looking animal. I want to talk a little bit about ASML. We were having this conversation with Mike Shepard that this isn't a blanket story, potential China relief that you can apply to the entire industry. You take a look at ASML still dealing with some of these concerns, really restraining their growth outlook too. Well,
in the case of ASML, look, they have exposure to TSMC, and we know TSMC is almost 50% of ASML's revenue at this point, in terms of the tool sales. But they also have exposure to Samsung and Intel. And Intel being in cost-cutting mode, Samsung doing poorly. So that is where, there are puts and takes when it comes to ASML's guide. But the bookings number was strong. Gross margin went up. So all indicators point towards increased demand for their AI-exposed tools, and they're just being conservative at this point.
I have a question about the U.S. strategy and the uncertainties around it, because you have the U.S. expected by Jensen Huang to approve those first batch of U.S. licenses for those H20 chips to China. But here's what's still uncertain. How many licenses are going to be approved? Then there's also whether the permissions will go beyond existing inventory for NVIDIA and include orders of new H20 production. What does that mean in terms of financial uncertainty moving forward?
Yeah, look, when it comes to NVIDIA, we know they are on their Blackwell architecture. So these are the Hopper chips, the scale-down configurations. And they're about to release their new Rubin architecture as well next year. So clearly, if you're a customer in China, you're looking forward to what else will I have access to after H20s. Yes, they may have H20 shipments from NVIDIA, but then these configurations continue to get better in terms of power and efficiency. And that's what will determine, what kind of sales NVIDIA will have in China and what it means to gross margin. At the end of the day, the latest chips that NVIDIA sells are gross margin accretive, and that's what you want when it comes to NVIDIA having that higher portion of the latest chips that they're making.
So NVIDIA, China is undoubtedly important, but you think about the competitive landscape in China specifically, and Jensen Huang has made the point that they've lost market share to the likes of Huawei and other homegrown competitors here. I think the number that he cited was their market share was 95%. It's gone down to 50%. Is the genie out of the bottle, or can they actually grow their market share once again? Maybe not to 95%, but above 50%?
Even in the U.S., when you look at their share in inferencing, it's not close to 80 to 90%. That was the case a couple of years back when training was a predominant kind of force when it comes to AI. So clearly the hyperscalers making their own chips, whether it's Google or Amazon, is having an impact even in US. And the same is applicable in China. I mean, there are hyperscalers, and then you have players like Huawei. So clearly, I think NVIDIA won't have 80, 90% share, but this is a growing market. We're talking about $1 trillion in data center spending. So even if NVIDIA has 60, 65% share, you're still talking about 500 billion plus in revenue if it turns out that data center spending will be close to $1 trillion in the next 5 years.
Mandeep, thank you so much for joining us this morning. That is Mandeep Singh of Bloomberg Intelligence, with a lot changing geopolitically and therefore a lot changing for some of the hottest trades on Wall Street. Now coming up, another hot trade, rare earth stocks surging on the Apple deal with MP Materials. We're going to talk about what the deal is all about next. This is Bloomberg Open Interest.
Welcome back to Open Interest. Let's take a look at the stock market where gains are fading right now. The S&P 500, I'm going to go ahead and call that unchanged even though the color is green. The NASDAQ 100 is already there. A big reason why is right behind me, actually. NVIDIA down a little bit. Again, this is such a huge company that just losing its gains really putting a weight on the index. I want to talk about some of the gainers today, though. Johnson & Johnson, as we've been speaking about, beat and raised quarter, and then you take a look at the rare earth companies as well. MP Materials has been absolutely on fire. It's backed by the Pentagon, and now it has a deal with Apple as well. So all of the stars aligning. 2.7%. You might say that's not that much, Sonali, but consider year to date, its gains are approaching 300%.
It's absolutely an incredible surge. And to your point, Apple had struck that $500 million deal to buy rare earths minerals from MP Materials, and it's sending rare earth stocks higher. We're going to bring in Bloomberg stocks reporter Matthew Griffin, who's been following the story. How many rare earth stocks are there, honestly? I mean, is this a trade that is kind of hard to find to begin with, given that rare earths can be hard to get as an asset?
Absolutely. This is not an easy sector to get exposure to if you're a U.S. stocks investor. MP Materials actually has the only operational mine for rare earth metals in the U.S. That's in California. And so I think that's why you look at some of the other names like Ramaco Resources. Their connection is actually that they're developing a coal mine that will produce rare earths sort of in addition to that. And then USA Rare Earth is another name that is actually currently building a magnet factory, which they say is going to be online commercially next year. So basically anyone with any connection to the sector and plans in the sector is getting a boost as investors look for way in.
And the ETFs are coming too. I can smell it, a whole batch of new filings on rare earths. But you make the good point. If you're looking for a pure play, it's really MP Materials, the only U.S. mine for rare earths. And give us the context here, Matt. When it comes to rare earths, we know that the U.S. is really eager to build out our supply. And I feel like maybe the average investor who's just getting socialized with the concept doesn't appreciate how important these are.
Yes, so I mean, at a high level, we all, it's a safe bet, use rare earths every day. They enable the colors in your smartphone screen. They're used in catalytic converters in cars. They're used in electric vehicles. You need hundreds of pounds of them to make an F-35 fighter jet, so the U.S. government really cares about them. And their mining, and especially their refinement, is dominated by China, which has become an issue during trade tensions when tariffs have ratcheted higher between the two countries. China has actually used export controls on rare earths as a way to gain leverage.
And that goes a long way to explaining why the Pentagon is also backing MP Materials. Matthew Griffin, great reporting as always. That is Bloomberg's Matthew Griffin. And coming up in the next hour on Open Interest, it's a big one. We have the CEO of MoneyGram joining us on the possibility of an IPO. We'll also speak to the CFO of Johnson & Johnson. Remember, a beat and raise quarter, even with the looming threat of pharma tariffs. And we'll also speak to Dwight Scott. All that and more coming up. This is Open Interest.
30 minutes into the trading day. You're seeing a light trading day, some weakness in it, rather, Katie, because you have the S&P 500 trying to still stay in the green, not having much luck. The NASDAQ 100 down 0.4%. The 10-year yield now at 4.4%. It's been knocking on the door of 4.5% throughout the week. What a weird trade. Welcome to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Katie Greifeld. Matt Miller is somewhere in Italy. And what's interesting about the S&P 500 actually slipping into the red is that you take a look at the breakdown, there's still 300 names in the green. So breadth is good, but the color is red. The color is red, and it's so interesting. You have real estate, financials, the regional banks that are holding things up. Even if the big banks are down on the morning. And speaking of big banks, coming up, Goldman is making Wall Street history. It reaps benefits from volatile trading, but investors are not latching on right now. Meanwhile, J&J shrugs off President Trump's pharma tariff threat and boosts its outlook. We'll speak to CFO Joe Wolk joining Open Interest later this hour. And pole position, talk of the town. Trump's economic advisor Kevin Hassett takes the early lead to become the next Fed chair. All that and more coming up, but we begin with earnings season. Solid results from the big banks boosting risk appetite. Here's Goldman CEO David Solomon speaking earlier today.
I want to recognize that despite the resilient global economy and market backdrop, much remains uncertain. Geopolitical concerns have intensified in many regions, most notably in the Middle East. Number of trade agreements have yet to materialize, and that the ultimate impact on growth from higher tariffs is yet unknown. At the moment, there's a sense that things are moving forward constructively, but developments rarely unfold in a straight line. With this in mind, we remain very focused on risk discipline.
Joining us at the desk, Tiffany Wade, Senior Portfolio Manager at Columbia Threadneedle. Tiffany, you look at the trade today, the start of earnings season with the big banks, not getting a whole lot of love. They have run up so much this year, which tells you that perhaps things are starting to cap out, that the bar is still set quite high, even though expectations have lowered for earnings season. Do you expect investors to be this discerning to companies across sectors as well?
I think you're right that the bar was very high, especially for the banks going into this earnings season. We've seen really good run up in the banks. They've had some good news recently with the CCAR results being much easier for the banks. I think positioning probably a little bit stretched for the banks going into earnings season. I don't know if you'll see that across other parts of the market. Certainly other areas like industrials, I think, or energy, maybe sort of less crowded from investors. But I think financials is certainly one area that people have been very positive on.
Absolutely. One of the best performers at a sector level this year. But let's talk about tech. How much do you need tech? I look at the action today, for example. The S&P 500 actually lower on the day, even though you have more gainers than losers. But you have Microsoft, Amazon, Broadcom, Meta, et cetera, a little bit lower. And it seems like that is just spoiling the party. So if tech doesn't show up, what does that mean?
I think you definitely need tech for the rest of the market to work. You mentioned that 300-something stocks are up so far today, but the market is still down. The breadth of the market has been pretty weak recently. I think we've had, a couple times during the course of this year, we've tried to see the market broaden out, but we've come back to the mega caps being the leader, and that continues to be the case. I think the earnings outlook for those mega cap stocks still looks very good for the rest of the year. Earnings growth for the Mag 7 or maybe the Mag 6 ex Tesla still outpacing the rest of the market for the rest of the year. So I think we'll see a good earnings quarter from those stocks, but I think you're right. We definitely need to see those continue to work because, AI is one of the best secular themes in the market right now.
I want to pull up the sectors as well here because to Katie's point, the trades that you're seeing working today are ones that are pretty interest rate sensitive. You have real estate higher on the day. Financials are also higher, but this is a little bit of a hidden trick here because financials, you would think that means the big banks, but it really doesn't. It's the regional banks that are rising today. So how much does this market really need an interest rate cut here to support valuations where they are?
Yeah, I mean, we've seen between, the CPI numbers yesterday that the expectation of a rate cut certainly in July has come down pretty significantly, probably close to zero at this point. The expectations of a rate cut may be creeping up a little bit today with the PPI numbers coming in a little bit softer than expected. I think that the expectations for a rate cut had been inching up over the last couple of weeks, and that's certainly contributed to some of the disappointing reaction we've seen in the banks yesterday and some interest rate sensitive sectors over the last couple of days. I think that it will be important to see the trajectory of interest rates for how trading goes for the rest of the year. But in the near term, that CPI number could be a little bit of a headwind to the market for the next month or so.
Speaking of interest rate sensitivity, I want to go to the small caps. I know that you're a large cap portfolio manager, but again, looking at today's action as a lens into broader sentiment, you actually have small caps outperforming today. Of course, they don't have big tech in there, so that goes a long way to explaining why. But you think about how the different size tiers are performing in this market, and you think about where needs a rate cut, it feels like the answer is really small caps more so than the Magnificent Seven.
Yeah, I think that's completely correct. Those stocks would benefit significantly more from a rate cut. You look at a lot of the Mag 7 stocks; they have very little debt, so they're not very interest rate sensitive. Obviously, the banks would be interest rate sensitive, but I think that the smaller cap or mid cap banks, even more interest rate sensitive than the larger banks, which have more diversified businesses. But I think that's right, and that's what you're seeing today.
Ultimately, how do you think the second half of the year plays out? To the extent that you do see a leg higher in the broader S&P 500, what's going to take it there?
Yeah, I think it's if we have a significant change back towards expecting rate cuts earlier in the year that will help. I think we'll probably see some volatility and maybe a little bit of a range-bound market, at least through the next quarter. There are some things that could be a tailwind to the market, probably more towards the later end of the year, and that might be if we start to see some of the positive impacts of the tax bill kick in or some deregulation kick in. But I think those are probably the positive catalysts we're looking for the rest of the year. But in the near term, could be a little bit range bound.
A little bit range bound. A lot to look forward to then. Tiffany, great to speak with you. That is Columbia Threadneedle Senior Portfolio Manager, Tiffany Wade. Meanwhile, switching gears here, the White House has begun its search for the next Fed chair. That is according to Treasury Secretary Scott Bessent.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Now, President Trump says that Bessent is an option, but Kevin Hassett is a top contender, according to Bloomberg sources. He has echoed the president's calls for lower interest rates. Let's discuss it all with Bloomberg Economics U.S. economist Stuart Paul. So it's still a Kevin, but it's not Kevin Warsh, which is where we had really been focusing a lot of our energy. Give us a lay of the land. When it comes to Kevin Hassett, what kind of profile does he typically take on when it comes to policy?
Well, so he's been around through both Trump terms. He has more credentials around tax policy, and part of the reason he's in the White House was to help with the big, beautiful bill and the extension of the TCJA. His monetary policy credentials aren't necessarily as robust as someone like Kevin Warsh, who served on the Board of Governors during the George W. Bush administration, or somebody like Chris Waller, who I think is a dark horse candidate because he has the more dovish bias, more dovish than somebody like Jerome Powell. He could deliver perhaps 4 cuts next year, where Powell might be slower to do that, and he has the institutional credibility, and he also serves as a little bit of a heat shield for the president, given that the president would sometimes like to deflect when economic data doesn't necessarily serve the White House's messaging.
Now, I want to delineate here what his views might be from how the rest of the central bank will vote along with him. Because, of course, you do want the president, should he choose Kevin Hassett, even if Kevin Hassett would be more willing to cut interest rates, should you believe so, then will he be able to do so as aggressively or anywhere near as aggressively as the president would like?
It would be far more difficult for an outsider to build the coalition necessary to show, let's say, unanimity when it comes to voting to cut rates. If you were to have somebody who might be a more dovish insider, somebody like Waller, you could see a coalition building around that person. So I think that it would actually be a little bit harder for Hassett to deliver the number of rate cuts, certainly the number of rate cuts that the president is arguing for. 300 basis points of rate cuts is way too much, and you'll never see a coalition on the Fed actually unifying around that premise. Somebody like Hassett would definitely struggle to deliver what the president president wants there.
Let's talk a little bit about Jerome Powell and what the Treasury Secretary said about the Fed chair. One of the things he said that Powell should exit the Fed board in May. We know that his term as Fed chair expires in May 2026, but he stays on theoretically as a Fed governor until January 2028. Secretary Bessent's view was that that would be very confusing for the market should Powell remain on the board. But talk to us a little bit about what history tells us and how what precedent there is for that situation.
I can only think of one example of a Fed chairman staying on past the expiration of their term as chairman and remaining on the board as a governor. It would absolutely depart with tradition if Powell did not give up his governorship upon the expiration of his term as Fed chairman in May. So Bessent is certainly right about that. We heard just yesterday also on Bloomberg Surveillance when Scott Bessent joined the Bloomberg TV crew, he was basically saying, look, the president is jawboning. He's working the refs, to borrow a turn of phrase from college basketball, as Scott Bessent loves to do. And so we shouldn't really expect to see the Fed chairman getting fired by the president. A lot of this talk is really premature. It typically only takes 2 to 3 months to confirm a new Fed chairman. So whether it's one of the Kevins or somebody like Chris Waller or Scott Bessent himself, this conversation is still going to be going on as we turn into the next year.
Stuart, we thank you so very much. The Stuart Paul of Bloomberg Economics, of course. It's also a busy week of economic data, so leaning on Stu a heck of a lot this week. But let's get a look at some of the single stocks moving at this hour because, of course, the big banks, they have reported yesterday and today, and you can see the clear winners and losers. Katie, this is fascinating. Goldman reported the best quarter for equities trading, the whole division. In Wall Street history, you do see now the stock fluctuating. It's been fluctuating between gains and losses. Goldman versus Morgan Stanley.
Right.
The market value has been dueling for the better part of the last year. This is fascinating because late last year, Goldman actually topped Morgan Stanley in market value for the first time since COVID. And you can see by that chart, they've been dueling ever since. Now, Morgan Stanley has run up so much that their price to book ratio is dueling with JP Morgan. So I would say on different valuation metrics, that's where they're competing there. But I'll tell you that the bankers are watching this chart closely.
Yeah, I would imagine so. It's interesting to see Goldman, at least when it comes to share performance, sort of running away with it when it comes to Morgan Stanley. Tough crowd today, though, because the stock is a little changed after that blowout when it comes to trading. But let's take a look at some of the other stocks on the move this morning. We've been talking about ASML all morning, plunging after walking back the company's sales forecast for next year. Global Payments too moving higher on a report that activist hedge fund Elliott Management has built a sizable stake in the company. That's according to FT reporting. And we're also keeping an eye on United Airlines. It reports after the bell today, and you can see shares rising a little bit in anticipation right now. We know that Delta was received pretty well the other week, so it'll be interesting to see the rest of the airlines come out here.
Yes, watching with bated breath. We are watching for that K-shaped recovery as well and how that's showing up in the airlines and other earnings. But coming up next, the AI revolution and the opportunities for traditional energy investors. It's a very complicated sector these days, and we're going to get insights from someone who knows best. Dwight Scott, Executive Vice Chairman of Quantum Capital, former Blackstone credit chief, next. This is Bloomberg Open Interest.
The investments being announced this afternoon include more than $56 billion in new energy infrastructure and more than $36 billion in new data center projects, and a lot more than that are going to be announced in the coming weeks.
And that was President Trump touting over $92 billion in investments in AI and energy infrastructure. The rise of AI is presenting both opportunities and challenges for investors in the traditional energy sector like oil, gas, and the new favorite, nuclear power. Here to talk about all the facets of the energy chain in the age of AI, Dwight Scott. He is the Executive Vice Chairman of Quantum Capital Group. Dwight formerly served as the chairman of Blackstone's credit and insurance business, and Quantum has over $30 billion in assets under management and is the leading private investor in the U.S. energy space. So let's get into it. Let's get into the traditional energy part of things, because you came into this year, there was the concept from the Trump administration that drill, baby, drill would be the three words that fueled this industry. You get into it, it gets more complicated, right? Because oil prices have been under pressure. How do you think about the supply-demand dynamic, especially with any concerns around the U.S. economy?
Well, you have to go back a little bit in time, because the industry has been drill, baby, drilling for quite a while. If you look at oil or natural gas, the production increase in the U.S. has been dramatic. It's been most of the increase across the world coming out of the U.S. This year is a little different. We've seen prices come down, and today oil is in the mid-60s. In the mid-60s, you get dangerously close to where oil prices don't really drive appropriate returns for new drilling. And you're seeing that. Rig count is off for the last 8 weeks or so, and so activity in the oil field is slowing. I think that's a temporary thing. I think it is related to price. It's related to uncertainty around tariffs and things like that. But you will see the U.S. continue to be a leader in oil and gas. And I mentioned gas because in all these conversations about what's happening with AI and what's happening with with growth in demand for electricity, natural gas is going to be critical there. And the U.S. is a leader in natural gas production. We have done an amazing job reducing the cost to find new natural gas in this country. But we're getting ready to see an increase in electricity, and it's hard to meet that increase with new production. And so I think we'll hear some noise around that. And my guess is you'll have guests on this program over the next 10 years talking about how the U.S. is able to meet the demand that we're going to see across the economy.
Is that appreciated by investors, though? Because we were taking a look at, of course, oil prices. You take a look at some of the big oil majors, for example, and their share prices over the past year or so are also going sideways. And you take a look at the valuations in that space, it always feels like they're a bit depressed, even though they're putting up these big production numbers. So, I mean, what is the broader market missing about that story?
Well, I think the industry gets a little frustrated sometimes because the industry is being very thoughtful about how they invest capital. The market told them, 5 or 7 years ago, hey, you need to reduce your capital spend. You need to create free cash flow. The industry's done an amazing job of that. There's been a lot of M&A activity. You've seen consolidation, all those things that have made us a stronger competitor. But you also have these outside forces. You have geopolitical issues, which have impacted prices this year. You have OPEC, which is coming back into the market with relatively large new production. And so if you're sitting in a CEO seat in a public company, you're thinking, I'm doing everything I possibly can, and now prices are moving against me. So there's a little frustration with that, but the industry will react to this environment. They always have.
There's the question around OPEC supply. There's the question around U.S. majors, as you were talking about. What does this mean about valuations in the sector and what it means for the propensity to invest in new assets? Is this going to fuel M&A, given that there's pressure, as you say, on the majors in terms of where oil prices are today and drilling as it stands?
Well, I just did this work for myself. I just joined a firm, Quantum, that invests in oil and gas. So I did all the work around that to think about what's the right place to spend your time. And for the last 15 years, really since the GFC, you've seen every asset class almost go up in value. Private equity has increased in value. The PE multiples have increased. Debt margins or spreads have tightened. And I thought we would see a change in that in 2022 when we saw an increase in interest rates. Inflation was out of control. You saw the economy start to slow. And we didn't see the impact on multiples. And that was very frustrating to some of us who tend to be value-oriented investors. Energy is the opposite of that. You saw a real decline in multiples in energy over the last 10 years. You've seen a constraint in capital available to that industry, both equity and credit. And so that has caused the energy markets to have an opportunity for better investing for private companies like Quantum or for public companies that are merging, and you're seeing all that come together today. So back to your comment about M&A, yes, you'll see more M&A. There's about half the number of public companies in upstream today than there were 10 years ago. There have been significant M&A transactions across power, across midstream. All those areas you're seeing that concentration, if you will. And on the private equity side, what you're going to see out of these companies is once they integrate those assets, they're going to start to think, where do I have large enough positions to be meaningful to me? And the smaller positions, they're going to start to sell off. And you'll see that cycle come back into the private markets, both on upstream and on midstream and power.
So, Joy, we're talking about pretty traditional energy here. I do want to talk a little bit about nuclear, because at least in the public markets, that's a story that investors have had to become sort of socialized to. You know, nuclear was not hot for a long time, totally different landscape right now. And we were speaking to the CEO of Oklo yesterday. What are your thoughts around nuclear? Is that something that you're approaching as well?
Well, nuclear is a game for big investors, and if you look at the last nuclear facility that was built in the U.S., Vogtle plant down in Georgia, its cost was originally expected to be $14 billion. It was $34 billion. A $20 billion cost overrun, that is $1,800 overrun for every citizen of Georgia. So that's significant. The U.S. remains the biggest, has the largest fleet of nuclear plants, and I think the U.S. will need to figure out how to build more. There was just an announcement about New York with Constellation. So I think it's going to be a bit of a slow burn. Nuclear is clearly a very reliable, low CO2 type source of power, but it takes a while, and we have to figure out how to make the regulatory process and the new build process, and importantly, we have to create some educated workers who know how to build these plants. It works in France. If you look, China's building 29 or 30 new nuclear plants right now, so we can do that. It's just early on.
Right, we got to leave it there. We thank you for joining us. Of course, it's fresh off the heels of a new job over at Quantum Capital Group. That is Dwight Scott. Now, still ahead, private equity wants to get into your 401k plan. President Trump is ready to open the gates with a new executive order, but we're going to give you the details of whether it's going to work out or not next. This is Bloomberg Open Interest. to check on these markets because, of course, we've been having a choppy trading day. The S&P 500 trying to break back into the green, but pretty much unchanged on the day. The Nasdaq 100 still in the red, 0.3% lower, and the 10-year yield hanging out around 4.4%. Of course, a defensive trade underway with the hope of rate cuts after that PPI data. The real estate financial sector is higher, but coming up, more financials with the CEO of MoneyGram. Stick with us. He joins us next. This is Bloomberg Open. And it's time now for the Wall Street Beat. It's the talk of the town. The Trump administration is finalizing an executive order that would allow 401k retirement plans to invest in private equity. This move would be a major win for the industry. PE stocks are rallying on the news. Many of these stocks have been under pressure all year. Joining us now with details, Bloomberg's private equity reporter Allison McNeely, who's been following the story closely, reported back in May that this was under consideration. Now, executive order to make this happen is a really interesting vehicle. There are a lot of regulatory bodies at play between the SEC and the Department of Labor. But first, describe the significance of this. How would this really change the business model? We know that every one of these firms has been trying to push further and further into retail, and this could be a massive gate that's lifted.
Yes. So private equity and all other sort of private markets assets have traditionally been held in professionally managed pensions, endowments, those sorts of retirement accounts. There's about $12 trillion sitting in 401ks or defined contribution plans. Those plans are largely invested in stocks and bonds. And private equity firms are really always looking for new frontiers for growth. They are, especially the public ones, they're trying to grow assets under management, they're trying to grow fees, expand their business. You've got some $12 trillion that they have not tapped. So if they could get even a slice of that, that opens up a whole new channel for growth and for revenues.
Yeah, and it's not just, of course, the Blackstones, the Apollos of the world. You had BlackRock's Larry Fink yesterday basically say that, or rather it was Martin Small, say that they're trying to get private assets in retirement funds in 2026. So asset managers of all stripes really psyched here. I don't know what to make of the fact that it was an executive order coming here rather than, something from the SEC or something along those lines.
Yeah, so an executive order really helps the government signal this is a priority for us. This is something that you should get to work on. And from the industry standpoint, it's an encouraging signal that, the Trump administration is taking their lobbying very seriously and saying, hey, we want to get into these accounts. And this is essentially the administration's way of saying, we hear you, and now we're directing government agencies to work on this and to look into this and to open it up.
It is wild to me that we could see private markets put in 401ks before ETFs. ETFs, it's like the final frontier retirement system of the U.S., but maybe private assets will get there first.
Allison McNeely, we thank you so very much for joining us, and I completely agree. Kind of wild times to see that happen so quickly. Anyways, crypto-linked stocks are also on the rise with Bitcoin. There's another thing going on in Washington here. President Trump says the House is on track to pass the Genius Act stablecoin bill today. This would be the first big legislative victory for digital asset advocates. One CEO following this news closely, Anthony Suhu of MoneyGram, I would say that the stablecoin bill is something that did see just a little bit of a hiccup yesterday, but now looking like it's closer to passing. Anthony, thank you for joining us here at the desk. Really interesting movement here when it comes to stablecoins, acceptance, rules of the road, traditional financial players like yours being able to use them. What role are they going to play, and how much, from your view, could it change the future of money?
I think stablecoin is going to touch every part of the economy. In fact, when we think about technology and how it adapts, I think the crypto space was waiting for something that could be legitimized by the government, but more importantly, stablecoin in and of itself is a killer app for crypto. And so what I mean by that is, just like the spreadsheet in the past unleashed the PC era, the browser unleashed the internet, I think that stablecoin is going to touch every part of our economy. And the way we're looking at it at MoneyGram is that it's going to touch how we run our back office in terms of how we work with our suppliers and how we pay them, so all the way to how we deliver and allow our customers to access programmable money on a day-to-day basis.
Why is it even more efficient or cheaper in some fashion than regular way money? Is there something that's too friction-filled about the current financial system that you have the likes of major retailers like an Amazon that would consider making stablecoin in order to create a new payment mechanism?
Yeah, I think the most important thing is that stablecoin first has an infinite ledger, so at any point in time you can basically track the whole history of money. But in addition, the thing that's really great about it is it allows for real-time settlement. So what that means is organizations that are working with capital, you actually do not need to pre-fund or forecast. In fact, you just kind of transact when the transaction's actually happening. And we're talking about sending money across the globe, which sometimes can take up to 48, 72 hours to settle. When you think about some of the networks like SWIFT, that's going to be able to be enabled in real time. So that's a huge unlock and will lower the cost in terms of doing so, because the cost of capital for the float gets eliminated with stablecoin.
Yeah, it's been fascinating to watch this evolution, to see non-native, non-crypto companies come in and think about launching their own stable coins. And I'll toss the question to you. When you think about your own business, could you see MoneyGram launching its own stable coin?
Well, it's certainly a possibility, and we certainly are thinking through this. I think in early stages right now, what we plan to do is look at how we deliver services to our customers from a B to B to C perspective. And what I mean by that is how we operate our treasury and how we actually manage and pre-fund our operations. And that's probably going to be the first area that we're going to be innovating in. And then as we look out, there could be a possibility that we'll offer our own stablecoin. It's too early to tell, but we're certainly learning about it. And I do think that this is a very exciting moment for money.
Well, keep us updated on that point. I do want to talk about how you see this evolving, because, as Sonali just walked through, you have a lot of companies thinking about launching their own stablecoins. Do you really need an environment where there's so many different stablecoins, or does it make more sense for everyone to just sort of coalesce around one?
That's a great question, and I think we'll find out. I mean, if you think about the world, there are a lot of different fiat currencies that exist today because for one reason or another, some might be due to every country's federal reserve to, controlling how they really want to manage your economy. So I think a lot of that stuff's going to play out, and if you think about kind of how the global economy works, there is one that's in somewhat a global currency, which is USD. And I think that there could be something like that plays out, but you'll have other currencies on top, like other forms of stablecoin that will ride on top of the value of something like USD.
A couple months ago, I spoke to you back at the Goldman Sachs Leveraged Finance Conference, and we were talking about your path as the CEO of this company. You're just over 8 months into the job, less than 9 months. You said at the time that you would like to take this company public again. This would be a goal of yours. So how should investors be thinking about that path?
Well, I think I'm very excited about the refounding moment of MoneyGram. The company's been around for 80 plus years. And, in terms of refounding, what we're trying to do is take the best parts of the organization while updating and rethinking how we do business. And one of them certainly is stablecoin. The other area is AI and how do we enable and operate in an environment like that. I'm very excited about the leading indicators after 8.5 months of what we're seeing in the business. In fact, one of the biggest areas in terms of our digital transformation is we went from a business that was about 18% digital back in 2019 to today it's close to 70%. And as we kind of evolve out and we play and evolve into this environment where AI plays a big role, stablecoin plays a big role, as well as overall rethinking how we enable and make the workforce more productive, I think that IPO, if we get it right, will certainly be in our path, but it's a little too early for us to say when.
Well, really looking forward to following that journey. Appreciate you taking the time with us today. That is Anthony Suhu, the CEO of MoneyGram. Meanwhile, we're just over an hour into this Wednesday trade, so let's get a check on these markets. The S&P 500 unchanged on the day, maybe slightly red if you're a pessimist. You can see that big tech is really what's leading us a little bit lower. We started the day green. We've firmly flipped now. The NASDAQ 100 down about 0.2% because you have NVIDIA, Microsoft, Amazon, Broadcom, all lower despite Apple and Tesla putting up a fight on the upside. And the bond market, the 10-year Treasury yield down a little bit, 4 basis points or so, a little bit of a bid coming into that long end, Shonali.
Very, very interesting. And the long end, of course, is what people are watching closely. Let's also kind of look at some of the stocks moving this hour. There are a few that are fascinating us. MP Materials surging after inking a $500 million deal with Apple and 2.9%. As you say, maybe that doesn't feel like a whole lot, especially for a company that's risen now closer to 300% this year. It's on track to meet that level. And Global Payments, with an activist investor, Elliott, the biggest one, has built a sizable stake in the company. And remember, Global Payments is so interesting here because you have the fact that it is pursuing big M&A. So you have activism and M&A embedded in the stock. Citigroup now down. I think this is interesting. Remember, Citigroup had recently brought on a very senior investment banker from JP Morgan to run its investment banking businesses. It's now poaching 2 senior bankers from JP Morgan in its hiring push, one as global co-head of equity capital markets and a new head of tech financing, Katie.
Yeah, interesting to see that little bit of a decline today. Remember, Citi had a pretty good day yesterday after it reported earnings, but we'll continue to watch that one. And speaking of earnings, coming up, Johnson & Johnson with a beat and a raise. We'll discuss with CFO Joe Wolk next. This is Open Interest.
month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff for the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
And that was President Donald Trump speaking yesterday about his prospective pharma tariffs. Enter Johnson & Johnson this morning, the firm shaking off potential industry tariffs, with CFO Joe Wolk telling Bloomberg News, quote, "There's an understanding you can't put up a biopharmaceutical manufacturing facility overnight. As long as those conversations continue to occur, I think we're in a pretty good position." I'm pleased to say that Joe joins us now on set, which is a nice change. Good to see you.
Nice to be here, Katie. Nice, Sonali.
So, big day, and you can definitely see that in the stock with the beat and raised quarter, but we have to talk about tariffs, of course. I hear what you're saying, that, you know, there is a bit of a phase in here, but J&J has promised to invest $55 billion in the U.S. already over the next 4 years. So, with that in mind, was it disappointing to hear that news from the president that tariffs are coming kind of imminently?
No, you know, I think as I referenced in the quote that you cited, the administration is very engaged with businesses, Johnson & Johnson as well as the industry when it comes to pharmaceuticals, about understanding the dynamics that make business work. If you look at the tax package that was really extended, 2017, and now extended through the One Big Beautiful Bill Act, manufacturing has come back in biopharm to the U.S. 22% since 2016 has been an increase for manufacturing jobs in pharmaceuticals. Compare that with all other industries, 3.8%. Yeah. We had about 1,100 facilities in 2016. Today we've got 1,500. So whether we can build facilities in a year or so time, that's probably a little bit optimistic. But the fact that the administration is just not throwing these on overnight, understanding the dynamics of potentially disrupting a supply chain and great health care for patients, I think that's a very positive sign. We have more manufacturing facilities in the U.S. than any other country in the world, than any other region in the world. The $55 billion will be able to amplify that. Mm-hmm. And to give you an idea, at the end of that investment cycle, we'll have all the manufacturing facilities to supply all the drugs for U.S. citizens out of the U.S.
And there's also the possibility that the goalpost could move a little bit as well, so we'll have to see there. And with that in mind, though, have you stockpiled any of your products for the possibility that we do hit that August 1st deadline and these tariffs go on?
Yeah, we have not done anything in our pharmaceutical group yet. Again, a lot of our active pharmaceutical ingredient comes out of the U.S. to begin with, so there's modifications to be had. We can make some of those choices, but right now we haven't jumped to any rash movement. We did include in our 25-cent earnings outlook raise for EPS, we did include $200 million in tariff costs. That is exclusively tied to our medtech business at this moment in time.
You mentioned the big, beautiful bill a little bit earlier. Can you get more detail into how the tax bill is actually impacting you at the end of the day, and what does it let you do that might be new?
Yeah, well, listen, I think it's an extension of what we saw in 2017. We amplified our investment in the U.S. since 2017, and the $55 billion commitment is a doubling down of that. We trust it. We made that announcement back in March. We trusted that the tax provisions would be permanent. This gives us a great background of certainty. If you think about the pharmaceutical business, the medtech business, it's very capital intensive. These investments take years to play out. It takes, right now, 5 to 6 years to build a biopharm facility. We want high quality product coming out because it's going into patients. So this gives us the certainty to not only invest in manufacturing, but R&D, in technology, those skill sets that will enable the U.S. to continue to be a global leader in life sciences innovation. I think about what Europe did about 45 years ago. They set price controls, right? At that point in time, Europe was investing 24% more than the U.S. Today, the U.S. is investing 40% more. We've got 5 million jobs that are represented by the industry, and that's only going to increase with good tax policy.
What about the capacity to invest in M&A? Because Johnson & Johnson, you've been pretty acquisitive, as we discussed in the past. I remember, of course, Intracellular Therapies, that acquisition really setting the tone. How are you thinking about it now? And specifically, how are you thinking about size and whether or not you're looking at pharma or devices?
Yeah, so let me take the second part of that question first. We've done, in the last 2.5 years, since the last day of 2022, we've deployed $55 billion in capital towards M&A. $45 billion were accounted for in 3 deals: Abiomed, Shockwave, and now Intercellular. All great strategic fits to our organization. The remaining $10 billion was over 80 different smaller deals. So in terms of size, we're looking at that strategic fit. How does it fit into our core areas of scientific expertise or commercial capabilities? And then can we generate a return that compensates shareholders for the risk that we're bearing on their behalf? You know, what I love about being many things I love about being the CFO of Johnson & Johnson, but I'm not forced to do a deal out of desperation. Look at these quarter results, right? We had Stelara, loss of exclusivity, last year an $11 billion product, the second largest in the company's history. $1.2 billion of erosion from second quarter last year to second quarter this year. Yet the pharmaceutical team grew the rest of their portfolio 15.5% to record their highest ever revenue quarter of $15 billion, first time ever. MedTech is continuing to improve. So with 26, soon to be 27 platforms or products that generate more than $1 billion in revenue, we don't have to be desperate in terms of doing a deal. We have certainly the financial muscle to do it with $20 billion of free cash flow on an annual basis, AAA credit rating. We can do any deal we want. It's just we don't have to do any deal.
Are you saying you don't like the valuations out there?
No, I think valuations generally are quite frankly meaningless to the team and I, right? We're looking for that right opportunity that we have an expertise or a capability that's going to generate more value in our hands than where it currently resides.
And Joe, I know we've spoken a lot about the political landscape, but we should also ask about drug pricing. Of course, President Trump made waves a couple of months ago. Time is a flat circle with the most favored nation comments on pricing. Curious to hear your reaction.
Yeah, you know, listen, we certainly agree with the Trump administration goal of trying to lower prices for patients here in the U.S. And I think if you look at, there's 2 primary reasons why that occurs. One, we've got countries outside the U.S. not paying their fair share. You know, you think about, and sometimes it's a clunky argument, but NATO, we're requiring to spend X amount on defense. Why don't we demand the same on health care?
It's an interesting comparison. I haven't heard that.
Yeah, but if you think about it, what's happening in these other countries is they're actually paying more to get less. And so what do I mean by that? Their individual tax rates are much higher than what we experience here in the U.S., yet their access to cutting-edge medicines are far below. To give you an idea, products approved within 1 year within the G20, U.S. patients have access 78% of the time in that first year. UK, it's 38%. Canada, it's 21%. You know, it's something that needs to be. They're not getting the best healthcare system. The other thing I would say is, you know, PBMs, 340B hospitals, the intermediaries and middlemen, and this is where the administration has actually picked up a tone of we need to create better transparency. Discounts and rebates in the industry have grown exponentially over the last 6 years. Our net price has declined roughly 20 to 25%, and Johnson & Johnson is not unique in that. Our peer set is the same. Yet, you probably know patients who are on a chronic med, going to the pharmacy counter on a monthly basis, paying $100, $125 for a copay when they used to pay $5 or $10. Insurance premiums continue to go up. Let's create more transparency in the system and actually reward the folks who are coming up with great innovation for not only patients, but the healthcare providers.
Certainly a lot of change coming in the pharma industry on pricing and regulation. And of course, in the earnings up ahead, it'll be a high bar. Of course, J&J raising earnings. That, of course, is J&J CFO Joe Wolk. Thank you so very much for joining us here on set. J&J having its best day since July of 2023, Katie.
Yeah, absolutely flying up 5.5%. As you said, really setting the tone here, seen as the bellwether, given that they're one of the big pharma companies to report first.
Yep. And stay with us because we have more C-suite insight. Tomorrow morning, we're going to hear from United Airlines CEO Scott Kirby. We'll be tuning into that conversation. A lot of questions about where the airlines go from here. Stick with us. This is Open Interest.
The second quarter unfolded with two distinct halves. The first half began with uncertainty and market volatility associated with the U.S. trade policy, and the second half ended with increasing engagement and a steady rebound in capital markets.
Morgan Stanley CEO Ted Pick speaking earlier. Let's get a check on these markets because, of course, we are watching the big banks. Really interesting trade here, Katie. Morgan Stanley now down 3.3%. Interesting because for Morgan Stanley in particular, about $60 billion was bought in to the wealth business below the $80 billion a quarter mark that the bank needs to really hit for its ambitious targets for net new assets. And, of course, CEO Ted Pick trying to drum up some interest there. Goldman Sachs down still 0.6%. High bar for the earnings season, and Bank of America down 1.4%.
Yeah, big time. A high bar and a tough crowd when you take a look at the reaction right now. Big declines when it comes to Morgan Stanley and Bank of America. Maybe Goldman Sachs getting off a little bit easier. Let's take a look at these broader markets right now because the S&P 500 still deciding what to do. You can go ahead and call that unchanged. Even as you have big tech lower on the day, the NASDAQ 100 down about 0.3%. So perhaps some resiliency when it comes to the S&P 500, fighting off those big tech woes.
Fighting off the big tech woes and the banking woes, too. And coming up tomorrow, we've got a lot more going on for you. A conversation with the OECD Secretary General and Rebecca Patterson to break down this complicated economy. Stick with us. This is Bloomberg Interest with Beth Central.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, NVIDIA's CEO says he anticipates getting the first batch of US licenses to export H20 AI chips to China very soon. Plus, more from Crypto Week on the Hill after Trump says the House will pass the Genius Act stablecoin bill today. And Elon Musk's XAI is in discussions to lease data center capacity in Saudi Arabia. We bring you the Bloomberg exclusive. Good morning. Let's get right to markets, and we are very focused right now on the chip sector. ASML, these are the Dutch shares trading in Amsterdam of the world's leading chip equipment maker or chip making equipment maker. The story is really clear. The vision they've given us for 2026, they are not holding to that in terms of growth or a year of growth. But what really spooked the markets was a comment from the CFO about how right now chip makers and customers are very worried about tariffs. We'll go deeper later in the hour. Then you have NVIDIA. So actually NVIDIA was kind of not doing much this morning. We know that Jensen Huang is in China talking up the success of being able to sell in a limited way some AI chips back into that market. Over the course of 3 days, we had a big gain yesterday, pushing the market cap well beyond $4 trillion. We're giving some of that back this morning. The anxiety in this Wednesday session is slightly linked to, let's say, the jitters from ASML. Anyway, Jensen Huang's been talking up a storm. Listen to this.
Some of the things that we wrote off might be harder to recover, but most of the things that we put on reserve will not be scrapped permanently, was not scrapped permanently. And so we'll compare what customers would like to buy now versus the inventory that we have, and then we can figure that out. It's probably not 100%, but it's not 0% either.
Let's get more on NVIDIA and the relaxation of some of those chip curves. Bloomberg's Mike Shepard joins us out of DC. And Jensen Huang's appeared a number of times, actually, in the last 12 to 24 hours in Beijing, in China. And let's say he's basking a little bit in what is a big win for him and a big win for the company.
Well, that's fair to say, because this really was a big turnabout by the Trump administration in basically lifting these export curbs on the H20 that it had imposed just back in April. And much to NVIDIA's chagrin, it prompted the company to take a $4.5 billion write-down in the previous quarter, and it had been looking at losses of perhaps as much as $8 billion in sales for the current quarter. So this is a potentially big gain, and Jensen Huang is saying that he is expecting those licenses very soon, Ed, although he didn't give an exact timeline. And there's still some unanswered questions about that, too, the scope of it. We don't know exactly what this backlog of orders that Jensen is saying are still on the books that they can fulfill very quickly once they get the licenses. And it's also not clear whether the permission that the U.S. government now is signaling that it will start giving extends beyond the inventory that Jensen was talking about that have been held up by the restrictions that were imposed. Likewise, we don't know if this will be a rubber stamp process by the U.S. In other words, will it be quick, as Jensen is suggesting, or will there be some bureaucratic tangles here? So there are some questions about how far this goes and whether this might extend to future chips that NVIDIA may try to sell there.
Bureaucratic tangles. There's also the political entanglement as well. There's been a lot of headlines, I think, in the last 24 hours with Jensen Huang in the center of them because he is in China. And there's a timing question because he met with the president of the United States last week. Do we use NVIDIA as any kind of sign that the relationship between the two countries, the United States and China, is evolving or changing in real time as well?
You know, it really does fit into the broader picture of how U.S.-China relations are really evolving fairly quickly. Since Liberation Day, when Donald Trump imposed, these eye-watering tariffs on the world's second largest economy, really prompting a reckoning between Washington and Beijing and forcing negotiators from both sides to sit down and really hash it out over trade. They didn't get too far into the weeds, but they did address some of the key issues, and they included export controls. The U.S. has been concerned that China had been holding back on sales of rare earths elements to American customers, and likewise, Beijing have been complaining about export controls, like the ones that we are talking about applying to the H20 chip, but also to chip design software and other elements. So we got a sense that there has been a little bit of a quid pro quo, something that Treasury Secretary Scott Bessent acknowledged during his interview with our colleague Anne-Marie Hordern yesterday morning, and something that we are seeing fitting into this broader pattern of perhaps a little bit more rapprochement. Secretary of State Marco Rubio has been meeting with his Chinese counterparts to try to set the stage for a summit between President Donald Trump and his counterpart, Chinese President Xi Jinping, sometime before the end of the year. And likewise, Trump has also been signaling a softer tone. He's saying that he will fight China in a friendly fashion. And likewise, according to reporting from our colleagues Jenny Leonard and Mackenzie Hawkins inside the room, inside those meetings at the White House, Trump is one of the least hawkish voices when it comes to China.
Bloomberg's Mike Shepard in Washington, D.C. Thank you very much. Let's stick with the semiconductor space broadly. This is shares of ASML, right? The world's most important leading edge maker of lithography machines, EUV lithography. They're used to manufacture chips. And what has happened this morning is the company's walked back its forecast for next year, 2026. Let's get out to London and Bloomberg's Henry Wren. That is a part of the story, right? So in that European session, the stock's off lows, but down more than 10%, Henry. The other part was the CFO saying, our customers are really worried about tariffs right now. Give us the summary.
Yes, yes, indeed. So usually every quarter when ASML trades, it trades about its orders intake number. This quarter, the order intake number is satisfactory. It beat estimates. However, one line in this press release really caught traders' attention, and that's CEO saying that although the company is still preparing for growth for 2026, the company really couldn't confirm that at this stage, because that contrasted with the company's messaging about 3 months ago, saying that based on its client conversations at that time, 2026 was still expected to be a year of growth. So this really dampens the sentiment, as you mentioned. We see sell downs in some other chip equipment companies today as well, including Applied Materials, KLA in the US, as well as ASMI, B Semiconductor as well in the Netherlands.
What about the quarter gone? I mean, is there any sense of how the health of the business is right now?
Yes, so let's focus on the EUV first, because that's the most important growth factor for the company. And according to the order intake that we've been seeing in the past quarter, it does seem that TSMC has been putting into more orders, which is ASML's most important customer. However, for many other customers, the uncertainty level is on the rise. We talked about, the Trump administration is backtracking many of its eye-watering tariffs. However, based on the conversations ASML has with many of its clients, it does seem that the uncertainty level is on the rise rather than on the decline. ASML explained that it's because of two reasons. On the direct side, you still have this Section 232 investigation going on the U.S., which means the tariffs imposed to chips and chip-making equipment is still unknown. And on the other hand, you have this tariffs impact on the economy, which many chip makers are more concerned about. So on the direct and indirect side, the company is getting more cautious. Its customers are getting more cautious. So that's probably why you see the company walking back its guidance a bit today.
Bloomberg's Henry Wren out of London. Thank you very much. Let's get to the chip and AI sectors in greater depth with an investor, Jay Hatfield, CEO, CIO of Infrastructure Capital Advisors. It's hard to know whether to start on trade and policy or the politics of the day between America and China, or the idiosyncratic that Henry was going through. But right now, tariff seems to connect all of those things. What are you seeing across the technology sector in how investors are responding to tariffs, but also how the companies themselves are communicating the impact?
Mm-hmm. Thanks, Ed. It's great to be back on. Well, the way we look at tariffs is they're actually very positive for the U.S. and very negative for the rest of the world, and you're seeing that today with ASML. But U.S. companies are mostly, except maybe Apple, mostly unaffected by the tariffs. A lot of them have local manufacturing. So you continue to see tech stocks lead the market. But what I think most people are missing is the revenue benefit to the U.S. So we're forecasting $300 billion of revenue from tariffs, which is really the run rate right now. And we're also forecasting that the budget deficit declines next year to $1.4 trillion only. That's only 4.5% of GDP. So nobody else is really looking at those numbers. It is good for the U.S. to collect revenue, pay down or have less of a deficit, which ultimately will be invested and help the economy.
Jay, I think the top story over the course of several days has been NVIDIA, the world's most valuable company, now being more free in a limited way to sell chips back into China. It's a headline and it's a single company, but what does that signal to you on the policy side about how America will continue to trade with China?
Well, I think what you're seeing is that the Trump administration, notwithstanding the tariffs, which can be negative for a lot of companies, and trade restrictions, which hurt NVIDIA 3 or 4 months ago, is that they are pro-business. And if you lobby the administration, they are open to changing policy. So ultimately, that's going to support the stock market. It's going to be bullish for tech companies. So they're just way more practical than the prior administration and way more pro-business.
You track a series of economic indicators, right? What is your projection on the net effect of this administration's policy? Do you see growth near, medium term, long term? Or what do you think we're being set up for going forward on the fiscal side?
Well, it's fairly complicated because tariffs are negative for the economy in the very short run because you just take, it's really like a sales tax, so you take buying power away from consumers. But the real issue is the Fed is misanalyzing tariffs. They're not treating them as one time. They're sticking with their archaic expectations theory of inflation that tariffs might cause expectations and spiral out of control, which we think is no longer the case. No longer the case.
Sorry to interrupt you. Let me ask you this. That's your view on this current Fed administration, right? I have to acknowledge that in the markets right now, there is movement across assets on the reports and speculation about what the administration may or may not do vis-a-vis Fed Chairman Powell, right? I think we see that in the markets. What do you make of that?